So debits, this is like a little mnemonic I just have here, just little funny things I try to make up to help you remember stuff, right? So debits increase, expenses, assets, and dividends. Dead. Dead. Debits increase, expenses, assets, and dividends. What one do I think might be the thing that you may not remember as well? Is dividends. Debits increase dividends, right? Because as you pay out dividends, you debit your dividends account, right? Which is in your equity section, right? So debits increase, expenses, assets, and dividends. Retained earnings, right. So debits increase, expenses, assets, and dividends. Dead. On the other side, liquor. Dead and liquor. Okay? So what do we credit? We credit liabilities, income, common stock, capital, owner's equity, retained earnings, revenues. Liquor. Dead and liquor. Yes? As what? It's just, I made up the mnemonic, so it's whatever it happens to be. Someone else made up another mnemonic. There you go. Yeah. You could use whatever works for you. Just little things, again, just to help you remember as you're learning. Like I said, most of you have taken one class, maybe two, maybe not taken them for over a year. These are just things to help you jump back on the bandwagon, on the accounting bandwagon. Now you'll remember all this stuff. Okay? Any questions on anything I've talked about? Okay. So now we're gonna play a game. And the game is called, does a debit increase or decrease? Wait, no, but I'm going to give you the item, right? It's not that easy of a game. Does it increase or decrease inventory?
Increase. Yes.
Debit increases inventory.
Increase inventory.
Right. So I'm sorry this is tiny. There's a lot of them, and I couldn't figure out how to, so it is what it is. Depreciation expense. Good. Accounts payable. Decrease. Good. Good. Sales revenue. Good. Common stock. Decrease. Because what kind of account is common stock? It has a credit balance, because what kind of account is it? Equity, right? And equity accounts generally have a credit balance, right? Unless you're dealing with a loss. So when you issue common stock, you would increase it with credit, decrease it with a debit. Wages payable. Good. Cost of goods sold. Right. What kind of account is cost of goods sold? Expense. Good. Good. Utilities expense. Increase. Good. 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 Haven't talked about this one. Allowance for uncollectible accounts is what kind of account? Contra asset account. Is it a contra asset account, right? So, so it would decrease, right? Allowance, so you just think it's a contra asset. So normally debits increase assets. If it's a contra asset, then it would do the opposite. It would decrease it, right? What is it a contra account to? Accounts receivable, right? Allowance for uncollectible accounts is a contra account to accounts receivable. That is the account. So, yeah, so what you would use that for, so I'll give you an example. I mean, this is, when we go through accounts receivable, this example is not that valid, but it's a kind of simple example, so I'll give it to you anyway. So when I was working as a controller, we had set up accounts receivable for rent for various tenants. There was a tenant in there that never paid its rent. And it was kind of an affiliated company to one of the owners. So we let them stay in there, and they didn't pay their rent, and eventually they moved out. And we didn't know if we were going to ever get any money for them from rent. So we set up an allowance account. We basically it's like writing off that accounts receivable, setting up an allowance account is saying, I don't expect to receive certain receivables. Although the reality is you don't really generally do it on a case-by-case basis. What companies tend to do is say, we estimate about 2% of our receivables won't be collected, so we set up an allowance account for about that 2%, right? Because the reality is your financial statements are supposed to show revenue earned, expenses incurred, right? Not necessarily when cash changes hand. So when you have receivables set up, you know at that time a percentage of them are not going to be receivable. You have to account for that as an expense at that time, as bad debt expense at that time. So maybe a lot of the reason some of you guys were saying contra revenue is because you're thinking of bad debt expense, which is the other side of that journal entry that you would make.
So it's basically like an assumption before it happens.
Right. You have to set up an allowance account for receivables that you don't expect to collect, not at the time that you know you have to write it off. Not at the time that you know you're not collecting. Okay, so the reason I said my example wasn't a great one is because generally companies don't work like that where they write off a specific guy. They just set up these estimates. Okay. All right. Bad debt expense. What does a debit do? Increase. Right. It's an expense account. Debits increase expense accounts. Good. Interest revenue. Decrease. Good. And last but not least. What kind of account is gain is gain? It's a kind of revenue account, right? It goes on the income statement. Decrease, right? Okay. And we're going to go over this later, but I'll tell you now so that I can repeat it later, so then you'll be more likely to remember it. A gain on the sale of equipment. So we have revenues, we have expenses on the income statement, and we also have gains and losses. Can anyone tell me what the difference is between a revenue and a gain? Why we call them something different? Yes?
Revenue is like if you make like a sale on something,
Mm-hmm.
and then a gain would be like you acquire something, not necessarily through a sale.
Yes, you're like right in the right realm. I'm going to add a little something to that. Yes, that's right. That's kind of what you're saying via example, right? The revenue that you earn is through operations. You may peripherally, I don't know, name a kind of company. Pepsi. So Pepsi makes sales on soda, right? They may own a property and sell that building, right? But that's not what their primary business is. So they may have a gain or loss on the sale of that property, but that's not part of their primary business. That would be a gain or loss on the sale of some equipment. That's exactly what you were saying via example, right? So you got it. I just want to kind of point that out, because again, other areas I think easy to forget as you're not doing this accounting stuff. So, okay. So now what I'd like to do is look at an exercise. So those of you who have a book, we're going to be doing exercise 3.1. So what I'm going to try to do now is figure out how to put 3.1 up here so you can actually do it. If you are sitting near someone who has a book, like make friends so at least you can get started on exercise 3.1. But in the meanwhile, I'm going to spend a couple of minutes trying to figure out how to get this to work. But again, so here on the second, they invested $30,000 in cash and equipment valued at $14,000 in the business. So again, I just want to make clear, this is from the perspective of the business, right? This is the business's books. So if you invest cash into the business, what happens to the business's bank account? It increases. So therefore, the cash account has to go up, and an asset has, what side is the increase side? The debit side. That's why you see we're debiting cash. It's the same for equipment, right? They're investing equipment. You can put, and think of this, don't think of this as like rules. Think of this logically, right? If you decide to start a business, right? I think I gave the example to someone up above here. you want to open up you want to buy a building to open up a gym, okay? You need money to buy that building. So you say, I'm going to invest money in this business to help buy this building. You're going to put money into the bank account of that business. That increases cash, and that becomes your stake in the business. That becomes your capital that you've invested in the business as up to that point, okay? So debit cash, debit equipment, credit owner's capital. On the second, they hired a secretary at a salary of $290 per week, payable monthly. So does anything happen when you just hire somebody? No, they didn't earn any money yet. You don't have to record anything right there. They didn't earn it. Unless you really have a sweet deal. Right, exactly. It's your advance, right, when you start. You're signing, unless you have a signing bonus, you're not recording anything, right. So on the third, purchase supplies on account for $700. Because it's on account, you credit accounts payable. Now here, we're debiting supplies. It says to debit an asset account. The idea here is that they're capitalizing the supplies and they'll expense them as they use them, okay? So the reality is, I'll just give you a little real-world infusion. I've never been at a company that's capitalizes their supplies. You just put it in supplies expense and you move on, right? Because who keeps track of these little things when you have a lot of things going on, right? You're a little like, we used a pen. Let's credit supplies and debit supplies expense. It's like cost benefit, you know, of the information. But here they want you to debit the asset, okay? So on the 7th, paid office rent of $600 for the month. So here, when you're paying rent, you want to charge rent expense. And again, this is all logical. If you're thinking, the terminology is just logical according to what the situation is. So you credit cash. Next, on the 11th, completed a tax assignment and billed the client $1,100 for services. So here, you actually did the work, so you have a receivable and you've earned that revenue for $1,100 because you've actually done the work already. On the flip side, somebody paid you in advance on the 12th for $3,200 for a management consulting agreement. Have you fulfilled your responsibilities yet? But you've received cash in advance of that, so you have revenue that has not been earned. So you have unearned revenue, which is what kind of account? A liability account, right. It's a liability account. So here you debit cash, credit unearned revenue. Received cash of $2,300 for services completed for a Ferengi company. So received cash for services rendered. It's another debit cash, credit revenue. On the 21st, paid insurance expense of $110. They're not telling you you've prepaid any insurance, so you just debit expense and credit cash. You paid it. So again, just terminology for those of you who haven't seen this in a while. When you pay something, you're either paying cash, you're writing a check, okay? You're paying it. You have to impact cash. If it says you've done something on account, have you paid it? No. So you should never charge cash if it's on account. You would charge either accounts payable or accounts receivable, depending upon whose account it's on, right? If someone bought something from you on account, it's receivable, right? If you bought something on account from someone else, then it's payable. Right, you got it. Okay. And on to the next. Paid the receptionist $1,160 for the month. Debit expense, credit cash for the $1,160. Account of supplies indicated that $120 of supplies had been used. So now they come out of supplies and into supplies expense. Now they're expense as they're used up. And on the 30th, purchased a new computer for $5,100 with personal funds. The computer will be used exclusively for business purposes. So what this is saying, yeah, the owner is investing. So let's think of this in the simplest of ways. Let's not think of it how it happened. Let's say this business realized that they needed a computer for $5,100, and it was going to cost $5,100, and they didn't have that. So the owner said, I'm going to put $5,100 of my own money into the bank, and then the business is going to go buy a computer. Right? Would that make sense? right, to do that? So what would happen then? What would be the journal entry? So the owner says, so if they figure out, we don't have enough cash in the bank, but we need to buy a computer. The computer that I found is going to cost $5,100. We don't have any money in the bank. So they're going to invest. He says, I'm going to put $5,100 into this business. So he's going to debit cash for $5,100, and he's going to credit owner's capital because he just invested more money in the business. Then what's going to happen? He's going to buy a computer, right, for $5,100. So what's the journal entry that you're going to make for that? Debit equipment for $5,100, and what are you going to credit? Cash. Right, cash for $5,100, right? Because you already did the owner's capital, right? So net, let's look at these two journal entries together. Cash is netted out, right? You increase cash and you decrease cash. So the net impact of this journal entry is a debit to equipment of $5,100 and a credit to owner's capital of $5,100. So alternatively, and more, even though this is, I think, a clearer path, the owner could say, a computer is needed by this business. It's going to cost $5,100. I'm just going to go out and buy it and give it to the business. It does the same thing. It just saves a step. Does that make sense? No? Where are you getting stuck? Tell me.
When I saw that last entry, I just debited the equipment $5,100 in cash because it's going to be used in the business.
But had the cash get into the business? This person took it from their personal funds. If you read what happened on that date, it says he took it from his personal funds. So let's say you own a business. You have a business bank account and you have your personal bank account. You cannot mix those two things, right? When you report as a business, does your personal bank account go on the business's books? No, only the books of the business, right? Only the bank account of the business goes on the books. So if you spend $5,100 of your own money, is that going to show up on the business's financial reports? No. You have to get it there, right? So there are two ways of doing that. One is by actually taking the $5,100 and putting it into the cash account of the business, and now you've made an investment of $5,100 more into the business, right? And now you buy the computer. Or alternatively, you can buy it on behalf of the company and now just have equipment, give the computer to them and say, I've made a $5,100 investment in the company. Give me a $5,100 credit to my capital. Okay, does that make sense? Okay. Any other questions on that transaction? Yes?
On the exam, we would put that credit first to get points on. Sometimes I could.
You should always put your debits first. In the real world, people make journal entries that are debit and then credit. It's not to say that it's going to post anywhere incorrectly, but you need, for good sound accounting, you need to put your debits and then your credits. You need to do that. You just need to practice that and make sure that you do that right. Okay? And I get that the debits and the credits are all going to go to the same place, but you're not going to, if you make credits and debits, it's going to confuse people. Don't do that. This is just an accepted way of doing journal entries. Okay? Debit then credit.
How about the equipment? We have two different types of equipment, and we have to write computer and installation plan. Because
What do you mean?
for the first transaction, we had invested in equipment.
Yes, but that's an account.
Yeah.
An equipment account can have all sorts of different equipment in it.
I'm just saying, if just in an exam, just write equipment, you don't have to equipment.
Don't worry about that. Don't overthink that, right? So equipment, in the real world, there may be, some people may have multiple accounts for different kinds of equipment, some may not, depends upon the kind of business. Don't overthink this, right? We're putting it all in an equipment account and it's fine, okay? All right, so any other questions on these journal entries? Is that a good refresher, getting back into journal entries? Okay, so now what we're going to do, I said we went part of the way through we've been part of the way through the accounting cycle, right? So we made general journal entries, right? Now we have to